Anna, there's something I have to tell you. So I think it was Monday on my daily financial news. Out of nowhere, I asked, who is your favorite millionaire guest? And you were the top of the heap. You got the most nominations, the most attaboys. You had people saying, I never miss Anna Kelly. And you and I have been doing this for 4 years. So thank you very much. The
Wow.
audience loves you.
Oh, that makes my heart feel good. Thank you so much. It's my
Yes.
pleasure to be here with you every week. It really is.
Awesome. Well, let's talk about the banking crisis. Obviously, late last week, we had all the kerfuffle around Silicon Valley Bank. We get slapped in the face with a surprise run at or issue at Signature Bank in New York. Then we had what is called the bailout, non-bailout, bailout. I have no idea because it's certainly a bailout to me. But more
Yeah.
importantly, I think we saw the next domino, which was Credit Suisse getting into some distress this morning. And frankly, they've been on, we've been watching them for quite a while. You brought Credit
Right.
Suisse to me 6 months ago, and I think you're absolutely right. So first, is it fair to say we're in a banking crisis? We'll start there first.
Yes, I would say at a high level, we are in a banking crisis. And I think that it could be worse than what people think. Um, I'm happy to elaborate on that too.
Yeah, well, why don't you go? Because again, this is a big topic. You and I have experienced the Great Recession up close and personal. You
Yeah.
are intimately involved at AIG, and if you don't know who
Yes.
AIG is, go back and look who had all the CDOs and stuff on their books.
Right.
So she was in it. You also have a banking background. Uh,
Yes.
Neither of us are old enough to be buying properties in the 80s, but we both have studied and researched the S&L crisis.
Right.
So
Right.
we have a longer history than your average Joe with banking crisis. So talk about,
Right.
elaborate, what do you think's going on kind of under the surface, and then we'll go deeper.
So, what's really interesting, and we've talked about this for, loosely on this show, that the risks of continuing to raise rates is that we start to really break something in the banking, the credit, the derivatives markets. And essentially, what's happening is as rates are rising, the risk-free rate of return goes higher and higher. And so people want greater returns than what they can get in treasuries. They start wanting a discount on assets, and assets across the board start to become devalued as people's look for a risk-free rate of return. Well, what was interesting about the 2008 crisis is most of it was from toxic assets that were on the books of financial institutions, and we're going to say those are mortgage-backed securities loosely, right? So we had basically these mortgage-backed securities that weren't worth what they claimed to be in terms of their safety, because they were risky loans to people that didn't have good credit. And then there was insurance, these credit default swaps on the value of each other, and that
That's when
kind
it
of
got
together.
interesting, when you added leverage to
Yeah.
the the bad assets. Yeah.
Yeah, so two things, bad assets and debt can tank ships, right? And tank economies. Well, what's happening now is that actually Silicon Valley Bank, and they made some mistakes, right? And I, at a high level, I'm learning about this in real time as everybody else is, right? So what we know today is they did make some mistakes, but the reality is what they were invested in before a year from now would have been considered one of the safest things
Oh.
possible for them to invest in, which
Mhm.
was US securities, right? Backed
Yeah.
by the full faith and credit of the United States. And so this bank essentially, and many banks, Michael, and this is where it's not probably getting enough news exposure.
Correct.
Basically, when they take deposits, they make money on two different things. They lend out that money, and then they invest that money in securities. And so
Mhm.
part of the safety of a bank is investing in safe securities like US Treasuries. Well, now US Treasuries, because interest rates have gone up so much, they have long-term treasuries have tanked in value. So let's say I read that I think their average return on their long dated bonds was under 2%. It was like 1.2 or 1.6, something like that. So now you can get a treasury at between 4 and 5%. So why would somebody buy treasuries from Silicon Valley Bank, right, that pay less than 2% when they can go buy something that pays 5% today, 4 or
Yeah.
5%? So the value of those bonds has tanked close to 75%. And what people don't realize is that the securities that banks are holding as collateral and part of their reserves, because they're kind of like cash equivalents, they can
Yeah.
be traded fairly quickly, right?
Mhm.
the US government debt is now the toxic asset. So it's the thing
Exactly.
that was once safe, and now it's the toxic asset of the 2008 crisis. And so the question is, how many banks are exposed to having to sell and then take huge losses? And what my fear of happening is, that could lead to many more bank collapses, is if the banks had to sell these assets.
Mhm.
What people don't realize is these assets are held oftentimes off of the main part of the balance sheet. So if they go down in value, they don't have to take losses
Yep.
until
Held
they
to
sell,
maturity. Yeah.
but
Held to
hold to
maturity.
maturity. But if they sell a single asset from that hold to maturity block, they have to revalue at today's value all of their hold to
Mark
maturity
to market.
assets. And
Yep.
so that's what happened. Silicon Valley Bank had a lot of depositors that wanted their money out. They had to sell some securities, then they had to mark down, huge losses against their portfolio. And that's what made them insolvent. It isn't that suddenly they were more risky today than they were yesterday. It was that on
Yeah.
paper they are now insolvent, and that creates a crisis. So
Yeah.
theoretically, what could happen is people panic. There's a run on lots of banks, and they have to start selling bonds. I think the Fed and the Treasury stopped that contagion,
Correct.
because they basically came out Sunday and said, we're going to lend to all the banks any money
Yeah.
they need, and the banks aren't going to have to sell these securities and mark them down. And
Yeah.
that should slow things down, but there's still tremendous risk, in the market, in insurance
Yeah.
companies and banks, all kinds of financial institutions, that may not be enough, right?
Yeah, I'll do a little bit more on Silicon Valley Bank, but I want to pivot to Credit Suisse because I think in this grand scheme of things, Credit Suisse will be 10, maybe 20, 30, 40 times bigger problem, and that scares me. I think the banking crisis got worse today because of Credit Suisse. I want to talk, just kind of round out Silicon Valley Bank, because I think what was
Yeah.
announced Sunday kind of alleviated a couple of things. First and foremost, I don't know if
Yes.
you saw this, but FDIC 2 weeks ago, I think it was two, might have been 3 weeks ago, basically put out a shot across the bow and said $680 billion are sitting on US banks, unrealized losses
Right.
because of toxic, I'm not going
And
to
do
call
you
them
know how
toxins.
much is available in FDIC insurance today?
I want to say it was like less than 2 billion. It was not enough, not a lot.
128 billion. So it's
Okay.
less
So,
than 20% of the
right.
possibility of these, losses. So
Yeah.
the FDIC, that's supposed to be able to insure the banks, has less than 20% of the funds to insure the losses. And
Mhm.
guess what FDIC is invested in? More
Treasuries.
US treasuries,
Yeah.
right?
So
So
again,
so yeah, just something
yeah.
to think
So,
about.
so one of the things that the Sunday bailout did, which I think most people missed, but is the key, is they now allow banks to take those what we're calling toxic assets and sell them at par, or get them, they're collateralized at par.
Yes.
So
Yes,
because they do
collateralized.
that, they don't have to take the loss.
Right.
And again,
Right.
we should all know that if you can hold these to maturity, they pay out. And
Yes.
the Treasury of the FDIC has the wherewithal to hold to maturity, so it's not a problem. So I think that
Yes.
$680 billion issue is now not an issue, because you have a buyer at par where you didn't have a buyer on Saturday. That's not technically a buyer, but you know what I mean. So I
Right.
think that issue is now removed.
Yeah, I probably wouldn't go that far, Michael. I would
Okay,
say that
please.
the hope is that it calms fears and it calms a bank run. Okay.
Sure.
Because if people understand it, and the average depositor has about $8,000 in a
Yeah,
bank,
I,
right?
I saw that. Yeah.
Those that have more money have about $79,000 in a bank. So there's not huge numbers of depositors that have up to 250,000. But
Mhm.
also, people are really nervous. And so if there is a run on the banks, despite this backstop, because people maybe don't understand it,
Mhm.
then we could still be in trouble, because
Well, yeah.
FDIC and the Fed simply doesn't have enough money to cover a bank run.
Yeah,
So
I
I'm not
agree.
saying, hey, there's fear, go get your money out of the banks. I'm not
No.
doing that. I still have my money in the banks too.
Yeah,
But
me
I'm
too.
just saying the issue doesn't go away, because the consumer and the consumer psyche really is powerful. And consumers have lived through now a pandemic, mass inflation, threats of deflation, layoffs, now banking, they're scared, Michael. And so,
Exactly.
we have to hope that the government can calm fears and that there's not a bank run. And as long as there's not massive bank runs, there will be some banks that collapse, and we'll talk about Credit Suisse here in a second. But the mass contagion that could have happened has been stopped by what the Fed and the Treasury did on Sunday. So I agree with you there.
Yeah, I totally agree. I think that's all right. Where I was going to go next is exactly that. As you know, when you study economics, if you actually get your head out of the spreadsheets and the numbers, it's actually a study of consumer psychology.
Yes.
And as you've just correctly said, and I said on the daily financial news today, consumer psychology has been damaged. Consumers are
Absolutely.
scared.
And the data
And
models don't show that. They don't take that into consideration. And I think that's where, data models of what's going to happen with inflation and CPI and all of these things don't really take into account
exactly.
a consumer that has been rocked by crisis after crisis
It
after
changed this
crisis.
weekend. It
Yeah,
changed this
for
weekend.
sure.
And that's what I said on the news. I said, this is good. I said this weekend could have been the weekend that started the recession. Because if you're
Yes,
scared of your money in the bank, oh my goodness, can you imagine something that would not make you spend, that would make you conserve?
absolutely.
So yeah.
Absolutely.
So let's switch gears, because again, I think Silicon Valley Bank, the bank run we had here, the bailout damages U.S. consumers. And frankly, I mean, this is true, but I don't know if it's a great thing, but it actually can reduce inflation. When consumers stop consuming and conserve, that will bring down inflation. So
Yes.
Powell may be slightly happy about that, which is kind of a side effect. But let's not go there. I actually think Credit Suisse is a huge problem, not for consumer psyche, but for big banks' balance sheet. I call Credit Suisse one of the top 20 interconnected banks in the
Yes.
world.
Yes.
And that's not good, because there are some bodies buried that could cause a lot of problems at the biggest JP Morgans. And I don't know anything, but I'm just trying to people realize Credit Suisse is one of those 20 that could damage all the other 19. That's my opinion. What do you think?
Yeah, they're very interconnected. And that's one thing that our financial system really hasn't learned enough lessons from 2008, right? I had no idea, even working at AIG, working in a division who my coworkers next door to me on the same floor were selling credit default swaps. I didn't understand them. I didn't understand how intricately connected banks are with other big financial institutions. And there are still essentially credit default swaps out there. I mean, banks
They're
are
called
very, very
something else,
tied
but yeah.
together.
Yeah.
Right, called something else, but they are very intertwined. So there's a lot of even deposits. People don't understand. You make deposits at a bank, and they're basically diffusing their risk by setting up deposits and sweep accounts with all these other institutions like
Yep.
Charles Schwab, like Credit Suisse, investment accounts, et cetera. So a lot of the banking system and the financial system are very intricately tied together. And that doesn't even account for stocks and bonds and securities of each other held by other financial institutions.
Yeah. Again, the headlines I read this morning about Credit Suisse, and again, you alluded to me at 6 months ago, so I've been paying attention. That one frightens me. Silicon Valley Bank, I mean, again, it's like a mile from where I live, right? So I have ins and people I know bank there and all of that. That
Right.
didn't concern me at all, right?
Right.
Most people are below 250. It was definitely kind of my corner of the world. It's going to hurt consumers, but hey, it'll help inflation, yada,
Yeah.
yada, yada. Sunday's answer was a bailout, even though they don't want to call it that. It drives me crazy. But Credit
Yeah. It
Suisse,
absolutely was.
that scares me because of what
Yeah.
we don't know. I mean, that's what we don't know. Silicon Valley Bank was a bank run for
Right.
very logical reasons. They were insolvent because assets got revalued. I get that, right? I'm an accountant. I understand how to read the statement. Credit Suisse, with all of the off balance sheet this and the tentacles and then the other tentacles around the world, that
Well, and
frightens me.
here's the thing, and we've alluded to this, and maybe we'll do a whole show on this on the derivatives market, right? But
Okay.
there are significant risks. I think it's a $4 quadrillion
Quadrillion,
derivatives
yes.
market.
Quadrillion.
Quadrillion. So Forget the trillions of dollars that we're worried about in debt. Derivatives are essentially significantly larger than the stock market, the bond market, the debt markets. And so, you've got all these off balance sheet, unregulated securities, basically, that are diffuse within the financial sector and the banking system. And so as rates go up and you've had this huge asset bubble that is basically correcting, the value of everything is essentially coming down and at risk as rates continue to rise, because they're valued based on the cheap debt that was used to acquire them. And so this isn't just we have a banking crisis. I mean, the mortgage-backed securities, something a lot of people aren't talking about, is mortgage-backed securities are still CMBS loans are still on banks' balance sheets. So they've got bonds, they've got mortgage-backed securities, commercial real estate values are coming
Commercial real
down. So
estate. Ooh.
the value of those mortgage-backed securities is coming down. The default on those mortgage-backed securities are coming down. So you've got kind of this a very diffuse issue that's the end of a big economic cycle that has tremendous amount of debt and overvalued assets that are coming down as the Fed continues to raise rates. And so I think you have a lot of things, Michael, that could break. Not just a few banks. Yeah. It's not just this one issue. It's what's happening in the stuff that's not on the balance sheets and what hasn't yet been marked down that needs to be marked down in all assets that are held by these financial institutions, not just bonds.
Yeah. So we'll wrap this episode up with this kind of closing thought. We'll see if you agree or disagree. I think there's a lot of mainstream media and a lot of YouTube, quote unquote, experts basically trying to relate the crisis that's just started with the Great Recession. I think that is naive. I think that is wrong. I think that is recency bias. I believe what we are going through is actually going to be very similar to the S&L crisis, which doesn't make me feel good, right? One of the biggest deltas in the S&L crisis to the Great Recession was duration. The Great Recession was essentially an elevator down and, stairs up. It was undoubtedly painful, but it was quick, relatively. The S&L crisis was a decade of just, accident after accident after accident. So I would ask more and more people to research the S&L crisis. I think a lot of the experts out there are doing a disservice, but I'd love to hear your opinion because maybe I'm wrong.
Absolutely. I agree with you that, we tend to only look back in human psychology for about a decade, right? And so the closest thing we've had to a financial crisis other than, pandemic was 2008. And so we're trying to draw all these parallels. And there are, to be fair, a lot of parallels, right? But if you go back to your point and you look at the savings and loan crisis, it happened after a period of mass inflation, a lot of, Volcker going after interest rates, rising interest rates. But what we had similar in both of those crises and even crises before, there's a really good book that I recommend. It's called The Lords of Easy Money. And it talks a lot about Tom Honig, who was on the federal the Federal Open Market Committee on the Fed, and how he continued to warn that the Fed keeps making the same mistakes and we have cheap, easy money and it creates these big asset bubbles and then they fall dramatically. And so, the Fed looks at any asset bubble as a big boom. They look at it as a good thing. And what happens is we make the same mistakes with debt, more debt, and asset bubbles. When you have high inflation, the bubbles correct and it creates big financial crises. And that's what happened in the 1980s with the savings and loan, is that there was so much real estate and oil that was backing loans that when real estate and oil crashed along with everything else, those loans, the assets became worth nothing and the bank's assets had to be marked down and they failed. And similar things are happening now. It's starting with bonds, then we've got commercial, mortgage-backed securities, and we've got other things. So I agree with you that it's more similar to the 80s savings and loan than it is 2008, and probably another great topic to dive deep in another show.
Very cool. And well, do me a favor, where can people find you? Because you put out amazing stuff, and frankly, they should follow you on Facebook, but you may be close to your 5,000 friends limit.
I am, but I have a Facebook page. So find my Facebook page at Anna Kelly, REI Mom. I'm also on LinkedIn, and my website is reimom.com, and you can find me here every week on your show.
Awesome. Thank you so much.